What if I told you that most people are making investing way harder than it needs to be? Warren Buffett, one of the richest men in the world, says that you could start building wealth today with a strategy so simple it almost seems too good to be true. And the best part? You don't need insider knowledge or Wall Street connections. This is the approach Buffett swears by for the average person, and it could change your financial future forever. Ready to find out how? Let's dive in. Number 1. The power of index funds. Buffett's first piece of advice to most investors is to put their money in index funds. Why? Because they're diversified, low cost, and they automatically track the market. In 2007, Buffett famously made a $1 million bet with a group of hedge fund managers that a simple S&P 500 index fund could outperform the complicated, high-fee strategies over 10 years. Guess what? Buffett won. The hedge funds, with all their fancy tools and strategies, couldn't keep up with a simple index fund. This shows how effective long-term passive investing can be. When you invest in an index fund, you are buying a piece of every company in that index. And over time, the market tends to go up. Even though there are dips and crashes, history has shown that the market always rebounds. By investing in an index fund, you are essentially betting on the long-term growth of the economy, and that's a bet that has paid off again and again. If you are enjoying the video, hit the subscribe button and comment down your thoughts. If you want to explore money-making strategies, click the link in the description to start your financial journey. Number 2. Keep your fees low. High investment fees can silently erode your wealth over time, and Warren Buffett has always been vocal about avoiding this trap. Imagine you are investing in a fund that charges just 1 to 2% annually. That might not sound like much, but over decades, those seemingly small fees can cost you hundreds of thousands of dollars in lost returns. Buffett often emphasizes that most people should invest in low-cost index funds to maximize their wealth, and for a good reason. Take the story of John Bogle, founder of Vanguard and creator of the first index fund. Bogle discovered that high fees in actively managed funds ate up a significant portion of returns, leaving investors with much less than they deserved. His solution? Low-cost index funds that trap the overall market and charge a fraction of the fees. Buffett has praised Bogle's work and even left instructions in his will for his family to invest in these low-cost options. Why? Because they keep your money working for you, not for the managers. When you reduce fees, you are directly increasing your returns. Compounding that grows your wealth exponentially. Don't let fees chip away at your financial future. Make every dollar count by minimizing the cost of investing. Number 3. Stay in for the long run. Don't time the market. Buffett has always said the stock market is a device for transferring money from the impatient to the patient. One of the biggest mistakes that people make is trying to time the market, buying when they think stocks are low and selling when they think they are high. But even professionals get this wrong most of the time. Take the 2008 financial crisis. When the market crashed, many investors panicked and short everything. Buffett did the opposite. He stayed calm and even bought more stocks while everyone else was selling. Fast forward a decade and the market had recovered, and those who stayed in the market saw their wealth grow exponentially. This is why Buffett urges people to invest for the long term, instead of reacting to every piece of news or market fluctuation. Stay calm, stick to your plan, and let the power of compound interest work for you. Number 4. Be greedy when others are fearful. Now, this is classic Buffett advice. Be fearful when others are greedy, and be greedy when others are fearful. What does that mean? It means that during times of market panic, when everyone is selling, that's actually the best time to buy. Consider the early days of the COVID-19 pandemic. Stocks were plummeting, people were panicking, and the economy is in a free fall. But some investors like Buffett saw it as an opportunity. They bought stocks when they were cheap, knowing that the market would eventually recover, and it did. Those who stayed in the game during those dark days sold their portfolios sold when the economy bounced back. This is an essential mindset shift for investors. Instead of following the herd, you need to think like Buffett. When the market drops, instead of panicking, see it as a sell, a chance to buy great companies at a discount. Number 5, simplicity is key. Don't overcomplicate it. Warren Buffett has always emphasized that successful investing doesn't require complex strategies. It's all about keeping things simple. Too often, people believe that to get ahead, they need to follow the latest market trends, dabble in exotic financial instruments, or constantly tweak their portfolios, but this mindset can lead to confusion and costly mistakes. Buffett's philosophy is clear: simplicity wins. Take the example of his famous bet with hedge fund managers back in 2007. Buffett wagered that over 10 years, a simple low-cost S&P 500 index fund would outperform a group of hedge funds that used sophisticated strategies. The result? The index fund outpaced the hedge funds, proving that even experts can't consistently beat the market. Buffett's advice to most investors is straightforward: stick to what you understand. He often mentions that you don't need to be a genius to invest well. Following simple, time-tested principles like buying quality businesses or index funds can lead to extraordinary wealth. Many people fall into the trap of overcomplicating their approach, chasing the latest hot stock or complex financial product. But as Warren Buffett shows us, keeping things simple doesn't just reduce stress, it delivers better long-term results. Simplicity isn't just a strategy, it's the key to success. Number 6, have an emergency fund. Always be prepared. Before you start investing, Buffett advises that everyone should have an emergency fund. Life is unpredictable, and the last thing you want to do is sell your investments during a downturn because of an unexpected expense. Think about how many people had to sell their stocks or dip into retirement savings during the 2008 crash or during the COVID-19 pandemic. Buffett believes in being prepared. Having 3 to 6 months worth of living expenses saved in a liquid, easy to access account gives you the security to ride out market storms. It's a safety net that keeps your long-term investment plan intact, no matter what life throws your way. Number 7, avoid debt. It will cripple your wealth building. Warren Buffett is adamant about one thing: debt is the enemy of wealth building. No matter how much you earn or invest, if you're weighed down by high interest debt, you're limiting your ability to grow financially. Buffett's distaste for debt is so strong that he advises steering clear of it as much as possible, especially consumer debt like credit cards, which can carry crippling interest rates. A powerful example of this is how debt can ruin even the highest earners. Consider professional athletes or lottery winners who make millions but end up bankrupt. Why? Because many accumulate massive debt, often living beyond their means, buying luxury cars, homes, or investing in risky ventures. When their income slows or stops, the burden of debt wipes out their fortunes. Buffett himself has avoided debt throughout his career, preferring to save and invest rather than borrow. He believes that while borrowing might offer temporary relief or gratification, the long-term impact can be disastrous. When you are paying off debt, you are not just paying back the principal, you are often paying steep interest, which takes a chunk out of your wealth every month. Avoiding debt allows you to stay nimble, invest more freely, and build wealth faster. Buffett's simple advice: if you can't afford it without borrowing, wait. Number 8, continue learning and stay curious. Buffett famously spends 80% of his day reading and learning. Even at 90 years old, he's constantly trying to improve his knowledge. He believes that continuous learning is one of the best investments you can make, whether that's about finance, business, or any other topic that broadens your understanding of the world. A real-life example of this is Buffett's late-in-life shift into technology stocks. For years, he stayed away from tech because he didn't understand it. But once he started learning more, he invested in companies like Apple, which turns out to be one of his best decisions. The lesson here: never stop learning. Whether it's about investing, business, or personal growth, the more you know, the better decisions you will make. If you like this type of content, then press the like button and subscribe to our channel.